Good morning, everybody. It is the 10th day of November, believe it or not, 2020. We have gotten past an election that has still not decided, and we are seeing some interesting market volatility. So I thought I would take a little time to share what I see with you and to tell you, I guess, to just relax with this because there's still a lot of things that are undecided. Okay, so hopefully you're seeing my screen here. Let me double check on my shares. Yep, that looks right. So we are looking at charts. So what we're looking at is this black line that moves right in here. So if you don't look at charts very often, sometimes I forget, and so I'm trying to be a little more attentive to that. So this line right here that's moving up and down, black, is whatever we're looking at. So this happens to be 7 to 10 year Treasury bond index per se. So iShares, which is a company part owned by BlackRock, runs this particular index. What we're looking at are treasuries. So since the beginning of this year, treasuries have ran up and then have sort of sat there at even for the rest of the year. If you're looking at sort of the range here, it peaked out right here, which was 3.9, and we've sort of been in that same trading pattern sort of place right in here the whole time. That's not a very good line, but you can sort of see what I'm saying. Right here sort of been the range of up and downs, and we're starting to drift down a little bit in treasuries, which has brought the yields up, believe it or not, to a screaming 1.22%. Woohoo! All right, let's look at the benchmark Standard & Poor's 500 index. Okay, this is the beginning of the year. This is the bottom of the COVID pandemic drop. And we've rallied back, dropped, rallied back, dropped, and rallied back. So are we going to go up from here? Just remember, stock prices are kind of pricey right now. So thinking that these things will continue to just roar up, is a little optimistic, but let's talk about this for a minute. So what's happening is anticipation of a new stimulus package. So more money into our economic system, which means basically when there's more money chasing the same amount of goods and services, it has to go somewhere. If you can get 1.22% on something that matures in 7 to 10 years, or you can take a chance at making some money in the stock market, it appears money is going to the stock market. So S&P 500, but when you look at it for the whole year, it's okay. But there's nothing amazing about this stock pattern other than this dramatic and huge drop that we had in March. So can that happen again? It most certainly can, so beware. All right, so when we look at the NASDAQ, this is where the money went. Money went to tech and healthcare, and this is the primary beneficiary of that, the NASDAQ Composite Index. So when you see the beginning of the year, another significant drop, but then money went to those types of companies that could benefit from people working at home and having to shelter, deliver food to your door, or you go and do the takeout type thing. Amazon, which could deliver the package to you. Microsoft and NVIDIA, they could deliver either the software or the microprocessing power to be able to allow you to continue to function using your technology. So NASDAQ has been the big beneficiary of this market rally. But just understand, these stocks are pricey. So when you look at Zoom, here's a chart of Zoom. So Zoom did this meteoric run, and it culminated with a market high the 19th of last month. And that was at 588. Today, the stock's 413. So just understand, these things that go up also will go down. So if you had bought Zoom at the top thinking it's going to keep on zooming, you're down about 27% from the top, although it has a great chart price. So again, buying it over here You can't go back in time, so be careful with these ideas. Also, you're paying 587 times their trailing 12-month earnings, so it's an expensive stock. It's not a bad company, it's a great company. Is it kind of expensive? Pretty darn expensive. If you look at, for example, Biogen, which is another company that was in the we might be able to make a vaccine business, you can see a big spike. So that stock went up on the 4th to $363. And $130 later, which was really in the next 2 days or so, we're back down to $236. So it's crazy out there. It's not a normal market. You know, money's moving around trying to reposture for an election, the anticipation that maybe a vaccine will take hold, and many other things out that are working in the periphery. So just maybe take a deep breath and don't feel like you're either missing something or you need to be out of the way. Just approach it with a more calm edge and try to look at it that way. Now the Dow Jones, which was fascinating here recently. So the Dow over here started the beginning of the year at 28,872. So we are, after yesterday's big rally, at 29,157. Will it continue to rally? Probably. But the types of stocks in the Dow Jones Industrial Average are significantly different than the types of companies that are in the NASDAQ. So you've got Boeing and JP Morgan, you've got Cisco and Disney and Coke and Chevron, you've got Travelers and Caterpillar in the Dow Jones Industrial Average. Those guys are not in the NASDAQ. So it has just now seen the light of day, because that literally right there where I'm pointing was 11.6. And so we had not yet gotten back to even. And yesterday brought us up quite a bit. So will we continue the rally in the Dow? We'll see. All right, so those are the domestic stocks. Also, if we look at, or the domestic stock indexes, if we look at sort of the different asset classes, what about small cap stocks? Everybody asked me, well, shouldn't small caps be rallying here? And they did. They've rallied 1, 2, 3, 4, probably about 5 or 6 days. And that's a pretty good rally. But over here is where they started at the beginning of the year. So no, we're not there yet. We're certainly way past this, but we have yet to get back to even to where we were at the beginning of the year if you're looking at the smaller companies. How about the mid-sized companies, the mid-caps? Again, a similar story to where we are just now getting back to even. Not bad. Yesterday was a nice little rally. I'll take it all day long. So small, mid, and large companies, I'll just use the S&P as our large company proxy, and you can sort of see how that worked. But you can see, okay, you know, things are okay. But don't let the hype get you emotional. Just stay with the program. All right, when we look at international, let's look at Europe, Australia, Far East. So MSCI, for those of you that are curious enough to want to know, that's Morgan Stanley Citigroup Index. EAFE is Europe, Australia, and the Far East. That's an index that does the developed countries. So again, almost back to even. Not too bad given what the world has gone through from coronavirus. So, you know, feel good about the fact that most of these companies have found a way to get back in there. All right, when we look at emerging markets, IEMG, okay, so this has had some outperformance. So the question is, how come emerging markets have outperformed? Well, the predominant country in this index is China. So if we just sort of isolated China and looked at that, China's had a fairly significant run this year, and it looks very similar to maybe our NASDAQ, maybe. I'll just do this as my proxy for the NASDAQ so we can see. So it looks very similar to the NASDAQ, the Chinese MSCI China ETF, which is a way to buy those shares. All right, so just understand some parts of the country, some parts of the world are doing pretty darn good. Others are struggling still, and it just is what it is. When you look at technology, and I'm using ETFs to kind of give you a look at that, technology, Fidelity has a technology index. They're fairly similar to all the other indexes that by tech, and you can see there's been a rally, and now we're kind of going sort of sideways. You look at healthcare. We dropped, we came back, and healthcare is pretty strong. So you go, huh, these guys look okay. If we look at energy, nope, energy's having a rough time of it this year. And honestly, until the price of the commodity oil goes back up, the stocks that are primary stocks in this index are going to struggle. So just be understanding of Chevron and Exxon and Phillips 66 and EPD and all these other stocks that are out there. So at the end of the day, just understand all is not fair. When you look at utilities, this would be like the Duke Energies of the world. Up, but not great. Okay? We're looking at a 2-year chart. I don't know why I went to 2 years here. Let me get off of that and just do year to date so we can see it a little better. No, just okay. Just okay. When we look at, say, discretionary stocks, interesting here, these are also the Walmarts and Amazons. Those are discretionary purchases. Ford Motor Company, things that you can decide to purchase. You're not sort of mandated to do, which would be more of the staples, FSTA, which also is done okay. So some of the economy is doing great, some of it not so great. So beware, but be calm. Things will settle down. We will find a vaccine for the coronavirus. We will get our economy back on track, and life will go on. It just doesn't seem like it, and it's getting a little old. But maybe there's some sunshine at the end of the train track there, and we'll just see how it goes. Wanted to share some with you, let you know that things are improving, and to stay with the program.